Welcome everyone. Welcome to this webinar Market Thursday. It's November the 18th. It's 8 p.m. here in London. So welcome for those of you who are joining right now and for those of you who will be watching later on YouTube. As always, a quick disclaimer. So this webinar is not investment advice. This is for information purely. So I do not take responsibility for losses incurred by the viewers. So please do your own research before doing anything. Quickly going through my background, I started working in the industry in 2000 in Paris, working for an asset manager. I worked there for 4 years, then I arrived in London, and since then I've been working from London. I worked first for a hedge fund where we were managing between 2 to 3 billion, first on the long only product, then on the long short product. From 2009 to 2019, I worked as a prop trader for Infinity Capital Market, which is a UK subsidiary of First New York, with an absolute return mandate, no constraints, asset classes or regions. I stopped trading at the end of 2017, start of 2018. I was a bit tired. From 2014 onwards, I've been doing mentoring. I worked before for another education company that I left in 2017. I restarted doing my own mentoring in 2018. I launched in 2019 the 4x4 video series, which is a video series to get an investment process. And I restarted trading for First New York at the start of this year. So this is something that I've been doing for the last 11 months, plus doing mentoring and some other projects that will hopefully come in the near future. So today, what are we going to be covering? We're going to be covering, as always, the situation across asset classes, looking at stocks, credit, commodities, and FX. So a quick market review and looking at the recent performances. We will be jumping just after on the technical analysis, the price action, trying to understand how those different assets and more particularly some stocks have been behaving. Then we're going to be trying to answer the conundrum between the some weakish US consumer confidence and the very strong retail sales that we have in the US. Then we will be looking at the seasonality and some numbers that we're going to have in 2022. So the expectation for 2022. So as always, quickly discussing about the market. We used to have in this market a long time ago some FX king. We had at the start of the year some kings of SPACs. So one king of SPACs. Before that, you remember probably the so-called king of bonds. And at the end of this year, we got tons of idiots who are proclaiming themselves the kings of stocks. And as very often, if you've been in the market for more than 12 months, what happens is those people who have huge ego will get destroyed and they will probably be hitting their own P&L, and the market will cut their heads. So the market is very, the equity market at least, is very hot on the back of easy money, on the back of strong US numbers as well. But that's really something that we're going to be covering today, especially as if you've been trading today, you saw the market is not closed yet, but we still got 1 hour left. But the market breadth is pretty poor, and the market has been at least today really driven by a few names like Amazon and Apple, and the names that were very hot, like the auto manufacturers or electrical auto manufacturers, some software today have been absolutely destroyed. So there is kind of reversal of what has been happening so far. In terms of catalyst moving forward, for the viewers in the US, you know that you get Thanksgiving next week, which is on Thursday. So the market is obviously closed on Thursday, and you only get half a day on Friday. So very often in the US, investors take literally those 5 days off, those 4 days off. So they are leaving on Wednesday and coming back on Monday. So there is not much happening. So we're gonna have in the next week or so some weak volume normally. Yesterday we had the VIX expiry at the open, and tomorrow we get the OPEX expiry, which explain a bit of intraday volatility that we had today and a bit of yesterday, where market makers and market participants are resetting their options exposure, theta, gamma, delta, whatever. Tomorrow, if you look at the exposure and where the market is pinned in terms of gamma exposure, we are around the 4,700. So there is, I think, 8 billion around the 4,700 and something like 6 billion around the 4,750. So those are the two natural pins, and particularly the 4,700. Other than that, no. So with Thanksgiving comes the Black Friday, the Cyber Monday, and that is really important to follow how the US consumer will be doing. That is true for any year because, as we know, retailers will start to be in positive territory in terms of P&L at the end of the year. But that is even more true after this COVID crisis. So far, the US consumer has been extremely strong. So that is the beauty of the US consumer. When you think that he will be struggling, actually comes even stronger. So as we're going to be covering later, the US retail numbers have been very strong. But that's really something to keep an eye on for the next 2 to 3 weeks. We are still waiting for the Fed chairman announcement, if Powell or Brainerd. There's a good chance that it's going to be Powell, meaning that nothing is really going to change. But over this week and tomorrow included, it's mostly about the option expiry. And this is what is driving this market. So in terms of asset class performances year to date, so the picture is very similar to what we had from a couple of weeks ago. Just, that part of the table is coming a bit down with as we're going to see after Bitcoin and WTI coming down a bit. But overall, the US market, equity market, is up more than 20%. So 20% for the Russell, that was as of yesterday, 25% for the S&P. The other end of the spectrum in terms of emerging market, again, picture is the same. Brazil is down 14%, and China is flattish, not really much happening. India is really the big winner in emerging market, but overall, because of the weighting of China in EM, we get the MSCI emerging EM that is flat on the year. Currencies with the dollar, actually the dollar has been stronger over the last month, 6 weeks. We're going to discuss that with the technical analysis. That is a view that we have been pushing, that the dollar could outperform the other currencies. Let's go into the just quickly the gold flattish. I mean, there is a lot of noise, and people are hoping that some investors are hoping that gold is gonna bounce, but still, stuck in around this 1850. Not much is really happening. Next page, with the asset classes performances week to date. So S&P, Nasdaq, actually Nasdaq outperforming the S&P, both at almost all-time high. So the risk on for US stocks have been pretty strong. Similar picture for developed market, which is explained again for the last months with option expiry. You get 10% up since the lows that we had a month ago. What is more interesting, before that was not really the case, is that part of the table. Again, dollar has been pretty strong. 1% move or 2% move on the dollar on a weekly basis is significant. Is a significant move. So there has been a flight to safety, or clearly US assets have been outperforming. So dollar strong, but that means that it has implication for emerging market as well, with for instance, the Turkish lira, which is making new lows, the African ZAR that is struggling as well. Interestingly, as you can see in that picture, that Bitcoin, despite the risk on, is down 7%. So I'm not a specialist and I don't want to go with a fight with any crypto people because I know that they can bark very loud. But what is interesting is Bitcoin, which is at 58,000, has been really underperforming the market in that phase of risk on. So I think it is interesting as well if you want to believe that some part of the US consumption doing fine, some housing buying has been done with Bitcoin, there could be some wealth effect here. And that tells you as well that some part of the hot market, memes, crypto, is a bit cooling down. WTI around the 78. That's something we're going to cover later. Sectors now, year to date on the left and week to date on the right. Picture on the year to date is the same. Energy has been and is still very strong, up 50%, followed by financials and real estate, consumer staples and utilities, which are defensive in a world where everything is risk on, have been by definition underperforming. On a week to date, as you can see, Nasdaq, triple Q, tech, really, that is here, has been outperforming the overall market. And here, if you look at consumer discretionary, which is XLY, where you get 20% Tesla and 20% Amazon. So Tesla is weak, is flattish on the week, but actually Amazon has been incredibly strong. We're going to be looking today at the chart and looking at the options. Tesla, Amazon is up 3 to 4% today, same as Apple. So really the market, again, we discussed that, has been concentrated on a few names. So meaning that very few names are driving the market. And the indexes, the passive investment are more and more driven by those few names. So if you look at the overall market breadth, which is, you know, the winners versus the losers, you have much more losers most of the time versus winners. But what really matters is really those big names, which are making a big weighting of those indexes and those ETFs. As long as they go up, those indexes will go up. So that's the case with NVDA, that's the case with Amazon, with Apple, with Tesla, with Microsoft, with all the FANG, where they're going to be making those, when those 7 to 10 names are going to be making between 20 and 50% on some of those ETF and indexes. And as there has been a strong commitment from retail, and I think from hedge funds and funds to play with short-dated options, that is driving the overall market. So be aware if you go for passive investment, what is your ETF made of? What is the weighting of the different components that are making those ETFs? Next slide, we always look at the bond market, looking at how the yields have been behaving recently. So week to date, the picture is more or less the same, but actually underneath this feel of nothing is really happening, the last 6 weeks, there have been absolutely carnage in the bond market and the treasuries / money market, based on bad reading or miscommunication from central bankers. That was the ECB. That's the case for the Bank of England and as well from the Fed, where market participants expected a week ago a more hawkish central banks, which didn't happen. So there has been a lot of bad positioning, and some big hedge funds have been absolutely murdered. So if you want to believe that funds and many investors could have 60-40, 60 equity, 40 bonds, or 50-50, 50% bonds and 50% equities, The pocket that is making 50% of their portfolio has been quite volatile, which normally doesn't happen that much when you're running bonds. So normally it's almost going the same way, but the volatility is pretty small versus the equity world. And actually, since September, there has been a lot of volatility, a lot of miss or false breakouts, and I think that created a lot of underperformance and a lot of tension in some of those portfolio. The VIX around 16-17%. Again, it's distorted by the expiry that is happening tomorrow, and from these huge numbers of calls, short data calls that are bought on single names. Top winners, top losers. Obviously, this is the earnings season. You could have M&A. That's the case for this earner with the 72%. There was a bid today. Roblox. So that's the Metaverse, something that everyone is looking at. We are discussing Metaverse in the with the community. We are trying together to find ideas and what could be not necessarily the names that have been already pushed, but some of the names to work with, and the losers, you get as always some earnings and some bad news on some companies. What about quickly? I give you those two charts. So before going into technical analysis, I like to be looking at some topic that is discussed by the market. You heard and you know about Metaverse. You know that Facebook is changing its ticker at the end of this month. So actually, what is interesting is the ticker Meta has been taken by another ETF, by an ETF, which is this one. So Meta has seen a lot of inflows over the last 6 weeks, and you've seen many names that have exposure to that story, to that topic, that have been doing very well. We are talking NVDA, we are talking Roblox, we are talking Unity, we are talking, Microsoft. So if you don't know which names to be looking at first, you go on Meta, you look at you go on Yahoo Finance, and on Yahoo Finance they will give you the different component of Meta. But why I wanted to discuss the Meta, because this is an introduction for our technical analysis. If I manage to switch into the technical analysis, this is it. So okay, let's start with that chart, which is, I think this is something that is quite helpful that you can do on TradingView. So you see the formula here, which is the FANG, Facebook plus Apple plus Amazon plus Microsoft plus Google. This is not perfect because it changed a bit. You can include Tesla now, you can include NVIDIA, and this is versus the SPY. But what you can see is a day like today, there is a huge dispersion between the S&P, that is smooth, that is up 30 bips, and actually names like Amazon or Apple that are very strong. So if we look at Amazon, let me give you that picture. Amazon really strong, from 35.50 to 36.77. It hasn't not making new highs, but if we jump quickly into the CBOE.com, and let's try to look at the chain and looking at the calls that are expiring today, you can see that for the 3600 today, 33,000 options have been traded, 43,000 on the 3650, and 66,000 for the 3700. 66 times 100, 66,000 times 100, that gives you 6 million shares versus the volume that is at 2.2 million shares. So again, that gives you an example that on any single day, people, some market participants, I don't think this is only retail traders. I think there is a bit of it. There is obviously retail traders, but there are people hiding behind those retail traders, and they will massively jump and be buying those calls. So try to, with different websites, I'm thinking about barchart.com and some others, where you can identify where is the frenzy going. for those options, because literally that will be driving the market. So Amazon, today we got Apple as well that is making a nice move. So it's getting closer to that trend where you see the strong move of the last couple of days on some announcement today about their auto. So it's 20 years ago everyone wanted to do a .com. These days, everyone wants to launch an electric vehicle. So probably this is what we should be doing instead of trading. So stocks, let's carry on with the stocks, looking at Roblox, because Roblox is making the headline. This is that has been the obvious play for the Metaverse story. So we had the gap on the earnings, a very nice follow-up. Based on inflows, but as well how to play Metaverse. Today, as I told you before, there is some reversal in all those names. So actually, I think there is a lot of pain for speedy and quick money for those quick retail traders, where names like Roblox, another name like Lucid, really have been destroyed over the last couple of days. So a bit of let's say, is it a change? I don't know, but there has been pain here. NVDA quickly, which has been making new highs, breakout. It's going to be a strong volume on a gap. So those names literally when they started to break, so this one, we discussed it before, when it broke from 230, it has been a one-way traffic on huge volume. And the stock is up literally 40% since then. Another name that I've been looking, which is the total opposite of that story, which is STNE, which is a Brazilian payment internet story, which is making new lows. So interesting to always to look at not only the winners, but how the losers have been behaving. What has been very interesting during this earnings season is actually the moves on the earnings have been absolutely insane, on the way up, and on the way down, meaning that if your style is to be playing straddle strangle for earnings, probably you've been making a ton, as long obviously as you've been long, but literally the moves, the realized volatility have been pretty big versus the implied volatility. So really big move. Another name that is making the headline, which is QCOM. QCOM very strong. Similar picture. You get the gap, and then you get a bit of consolidation, and then it carries on. So what you have during this earnings season is big moves on the earnings day, and then you get the drift or the follow-up or the earnings momentum after the announcement. That's true on the way up, and that's true on the way down. So Amazon we discussed, Apple as well. Let's look quickly at the indexes, looking at the S&P. We have not been making new highs today, but literally this is we have been consolidating for the last 10 days. In terms of really chart, let me give you a full picture. We are still getting close to this trend, to the top of the range. So you might have another 2% on the way up. Again, if you remember correctly, I've been short this market, which has not been working so well, but the position has not been really changing. Nasdaq Composite, not making new highs, but very close. Is it a question of on the close or tomorrow? But clearly the trend is on the way up. Quickly looking at Europe with the stock 600, today there has been a bit of weakening, but you can see the strength of the move from the 40.50 to 490, so that's 40 points. That's really a big move, 8, 9, 10% on many names. It's a one-way traffic. What is interesting these days, because I'm trading a lot Europe as well, is the volume and the volume and how the market depths. The market depths are very poor. So I'll give you an example. If you want to do let's say a clip of €250,000, €500,000 of stock like Siemens, which is a big company, you'll be really struggling to get filled. So there has been, I think there is a really, really poor volume and participation in Europe. And I think this is as well the case for less the case for the US, but US really, the participation will be driven by very few names. So be careful on where you put bid or where you trade, because the moves could be pretty sanguine. Philadelphia Semiconductor making new highs on the back of NVDA, AMD, so keeps on running. Again, it's a one-way traffic, the winners win. I don't know when you're gonna have the turn. Very often you have a turn either in December or in January. When people, that is the case very often in January, they come and say, oh, this year is gonna be different. So I got this idea that the losers of last year are going to be performing well, and the winners, they push too much. So you get a reversion to the mean of 3 to 5, I don't know, 10%, which could be pretty painful. But that's something to keep in mind. Either because we are getting close to the end of the year. So that means on the third Friday of December, most investors will be closing their book or reducing exposure. Or when they come in January, they come with a lot of new ideas and they reset their portfolio. Quickly, some follow-up on the crude oil. So as we discussed, that was a month ago, into the 83, 85. I thought that was a good short. I still believe that this is a good short. You are now nicely, not nicely, it's not like crazy, but you are in the money. So as long as you don't take the 85, this is I think the way is down. I explained why a month ago. This is still valid. Politicians are making a lot of noise for oil to come down. So politically, that makes sense as well for oil to come a bit. Quickly, two currencies, looking at the Turkish lira, which is, it's not funny. It's not funny at all. So it's not Tesla chart. It's not Roblox. It's a Turkish lira, which is plummeting every day, every week. This is a purely vicious circle. I don't know what's going to stop. You probably need you need a political decision, something to happen, because this is a one-way traffic. So we discussed that that this is an idea that was nicely pushed, I think, at the start of September. When it was around 9, shorting the Turkish lira worked very well. So those are these ideas that we are trying to work on. And euro dollar, a couple of weeks ago, I remember saying that, so we were around here, where I was saying, you know, the risk reward started to get mixed as long as we were not making new lows, but we have been making new lows now. So I think overall now, clearly to me, and I've been pushing along the dollar since 120. I'm on tape, so I'm fine with it. But I think the risk reward now is, you know, you go 200 pips so roughly. So I will say that now, if you've been running a long dollar and short euro, this is time probably to close that position. The move has been done. And I'm starting to see too many headlines of you should be long the dollar and short the euro, which start to tell me that you should at least be flattish. So we had a bit of a funny move yesterday when the Asian markets were open. Is it the reversal? Maybe not, but I think 112, 113 is a good level to close the position. Let's jump back into this metaverse and looking now at one of the topics that was introduced before, which is looking at the US consumer confidence versus the retail sales. So what has been happening, if you've been doing your work and studying, normally when you look at US consumer confidence, you'll be looking mostly at two indicators. The first one is the Conference Board leading indicator, and the other one is the University of Michigan. So this first one, Conference Board leading indicator, So you had the drop based on the COVID, and since then we have been making new highs and trading nicely. So the picture is telling you, oh, actually the US consumer is doing pretty well. And if you go into the University of Michigan, the picture is very, very different. So it's making new lows. We are 2012 level, and really that has been the trend. So University of Michigan has not been working very well as a tell of how the US consumer has been doing. I think some of the reason is the way it is constructed. There is a lot of weighting which is done on inflation, and obviously because inflation is going up, that does not help. So for your consumer confidence, try now to do a package between balance between the University of Michigan and the US consumer confidence, that the leading indicator that we had before, and don't put all your eggs in your Michigan. What I like really much with the US, with the Michigan index, is actually you get a lot of sub indexes. When you're going to be buying a car, if you want to be buying a car, what is inflation? So you have a lot of ways of generating ideas. I think there are 70 or 80 questions. So that's a good indicator, but not only the main indicator. On the contrary, this is the retail sales. Okay, so those are the core retail sales. So if you want to build your infrastructure, you need to go on the St. Louis Fred website. Everything is for free. You can download the data on Excel, and this is the picture. So you get a bit of a drop, and since then, boom. So actually, this is not even the trend that we had before. We go with this change of angle, and we are going up and up and up and up. So how can we explain, on one hand, the US consumer confidence being okay but not brilliant, and the US retail sales being so great? So if you look at one of the reasons, is obviously last year, when that was the end of the world, what we had is across the world, as people were scared, the personal saving rates went through the roof. Okay, so everyone was saving money, thinking, okay, what's going to happen? It's going to be pretty bad. So if you look at this move, we went from around 7 to 8% to the 30-35% saving rate, and we are back to this pre-crisis level. So this pre-crisis level is obviously this is the reversion to the mean. But if we look as well on this on the next page, which is the revolving consumer credit owned and by the US consumer, you can see here that if we go back into the level that we had pre-crisis, there is some way, some possibilities for the US consumer to consume even more. So before crisis, the level, which is this one, was around 1.1, and we are talking $1,000 billion. So $11 billion, whereas these days is so you get another 90 billion plus of potential consumption. So in other words, that means that the US consumer is probably not completely done, and there is still some upside. And why we want to say that is, and we want to say that because we had the checks in the US that stopped. So my thinking, and I was, again, like most of the time, I was wrong. I was thinking start of September that the stop of checks in the US will be an issue. But since then, the US consumer has been on a rampage and really consuming like there is no tomorrow, using back again this revolving consumer credit and using as well the buy now, pay later, everything. So with all those things, we don't have exactly the timing when it's going to stop, but that means you are just procrastinating everything. And as long as the Fed is very keen on having low rates, that means those cheap consuming possible. So I think really what's going to be key is by how much looking at the US consumer and as well the US confidence, how much this confidence could be impacted by inflation. Okay, so if we have too much inflation and the way that is spreading into the Michigan confidence, you can see that it is affecting the US consumer, but it is more perception than a reality, if that makes sense. In other words, there is inflation headlines everywhere, but the US consumer is still very, very strong and going like crazy outside. So when I'm talking to my mentees who are in the US, they would tell me, look, in San Francisco, this is really, really hot. In New York, this is really, really hot. In Texas, this is really, really hot. So everyone is going outside. Everyone is buying. The malls are crazy open. So as long as this US consumer is doing fine, you have, as we had last week, yesterday, the US retail sales very, very strong. We have companies like today that was Macy's. We got Home Depot just before that are beating the expectations, and not beating the expectations only on the bottom line, just faking the numbers, on the top line as well. So very, very strong retail. But that means to me that still inflation is coming down the line. So this is why we want to discuss the 2020 just after. So this slide was from a couple of weeks ago, looking at the seasonality. November is usually a very good month, one of the best months, or the best month overall since 2000, up 2%. So far on the month, we are up 2% roughly. December is normally an okay month, even though you could see and having some hiccups. So in terms of seasonality going forward, at least for the next couple of months, it is okay. Keeping in mind that we are already up 10% since everyone wanted to sell the market or going away from the market at 4,300, 4,400. So quickly, I want to discuss 2022 because it's half. We are mid-November now, only 6 weeks in 2021. So I'll try to be doing as I've been doing over the last couple of years at the start of in early January, the 2022 outlook and ID generation. I try to discuss IDs that we have for the year. This year, at the start, we discussed inflation, we discussed market, we discussed bonds, we discussed a bit of everything. So I would like to do the same. But here, quickly, we are looking at the S&P 500 sales per share. And so this is in blue, and this is on the left-hand side. And on the right-hand side, you get the year-on-year change. So as you can see, the trend is always up, which makes sense because the world is growing and you have a bit of inflation. Here you can see for the 2021, sales are expected to grow by 16.1%. So we only got 6 weeks left. So you should assume that we're going to get close to this 16%. And for next year, we are expecting to grow sales by 6.5%, whereas last year it was down. So this is the overall picture. And always when we do analysis, either for the big picture or for some companies, I like to be looking at the sales because I don't think you can generate earnings if you don't grow the sales. So for next year, market is expecting the S&P sales overall to be growing by 6.5%. Why I'm talking about the sales? Because if you start your analysis from the top line, which are the revenues, and if you look at 2019, you see we get 1383, 1329 in 2020, so minus 3%, then plus 16%. And so here, this is expectations and expectations, okay? So this is your top line. So from your top line, you're gonna come down, and you're gonna have your earnings, okay? So this is your earnings per share for the S&P. So if you take the 207 for the S&P here, and you take the S&P, which is at 4,700 divided by 207, and you end up with a P, okay? So this is some of the valuation that you can do. Not only, but that quickly gives you the picture. So In terms of year-on-year EPS growth, we had in 2019 plus 1%, minus 20% last year, plus 69%, and plus 8%. What I think works well for your analysis is to be comparing 2021 versus 2019 or 2022 versus 2019. You can see that both the sales and the earnings have been growing massively. Okay, so if we go into the next slide, we're going to be looking at the operating margins of the S&P. And why is it key to be looking at the operating margin? If you've been following the webinars, I've been talking about them over and over. On average, operating margin, if you see for the last 15, 20 years, we are roughly around the 12, 13%. Whereas in 2021 and 2022, it's around 17%. And that makes a big difference. So you can say that operating margins are on the way up because of new productivity, because people staying at home and using software and everything is much more productive. But I don't think that there is a huge change I mean, there has been some change, but I don't, by definition, normally operating margins are reverting to the mean. Okay, so you might assume that those margins will come back into the 13%. That is even more true if you have inflation and if you want to believe that at some stage you get a second round effect of inflation, which is wages going up. Okay, so if instead of taking 17% like you're going to have this year, you start to put the numbers down. So if we take 2021, so you get the sales of 1,500 times 16%. So that's the year over year. If you take the 16% or 17% operating margins, you end up with an EBIT of 259 and an earnings of 207 EPS. Okay, and now the expectations for 2022, those are these ones: 1645 for the sales. Using an operating margin expectation of 17%, you end up with 285 EBIT and 224. But let's do some math now, some pretending. And I like to do pretending because with my kids, I do a lot of pretending. Instead of using 17%, you use 13.5% operating margins for 2022. Meaning you take the sales here, 1645, times 13.5%, and you get $222 earnings, EBIT, sorry. Then if you take a bit of interest and taxes, and you say interest might go up a bit, and taxes, imagine that taxes only are at 15, 20% the way they are, you probably end up with 180, okay? 180. So the thing is, there's a good chance that operating margins will stay high next year. Okay, are they going to be at 17%? Tricky, but that makes a big difference if you are at 17%, if you are 15, or if you are 13%. Because if you are 13.5%, suddenly, instead of having something like 220 for the earnings, you got 180. And obviously here I'm using a big difference, a big delta between the two, which is probably too much, okay, because that gives you a change of roughly $40 earnings. So if you use a $40 earnings times, let's say 20 or 25 times, so that gives you between 800 and 1,000 points for the S&P. So that gives you a change of 20 to 25%. But literally, to me, and I'm not very smart, okay, and I'm just trying to figure out what's the story here. The top line has been very, very strong, okay? US companies have been doing very well with their exposure, with their new products, the way the S&P is calculated as well. So that has been working very well. For the operating margins, I want to believe that there is a chance that instead of having 17, 18%, we might have a reversion to them. And that makes the story completely different. Again, if you use the multiplier of the P. So when you use 20 or 25 times and you get a differential of $20 or $40 or even $10, $10 times 25, that makes 250 points. 250 points, that is 6% of the S&P. So clearly to me, you know, trying to linking of everything that we've done today, we look at the US consumer confidence. So this is the top line, but this is as well the margins. As long as the US consumer is ready to pay more, you can pass inflation to the US consumer. But at one stage, you might say, oh, this is it. You know, I don't want to be buying this thing, you know, 15% more expensive than it was a year ago. And you need to put the prices down. So, and that is possible to pay more as long, obviously, as you get access to money, which means that you can have access to credit revolving in the US, or you can do something that is very hot in the US these days, is buy now, pay later. But buy now, pay later is another way of, I give you a loan and you pay me later. But that tells you as well that the quality of the credit going forward is probably going to be, is going to deteriorate. So to me, look at those operating margins because they're going to be key for the S&P going forward, and that means looking at inflation and if the inflation could be passed to the US consumer. I hope it makes sense. Okay, because it's Thanksgiving and very soon it's going to be Christmas. Let's talk about a bit of my education. Looking at holiday discount. So I offer 25%. I've done that last year. It worked pretty well for the new subscribers. So if you want to subscribe to the 4x4 trading course, either for the 2 months or the 12 months, you can benefit from 25%. So that's a nice discount. When you subscribe to the 4x4, you get access to the community. I think this is a product that is starting to kick in. People will realize that this is a good thing, and I'm pushing hard for this. So 25% expiring at the end of December. So if you get any question, you can reach me. In terms of education, I do 3 things on top of those webinars. I do the trading community where I put ideas, I put content from brokers, from me, ideas, and I'm trying as much as possible to help people when they are struggling with something. I offer as well the 4x4 video series, which is 40 to 50 videos to get an investment process where you're going to have your infrastructure, when you're going to go through a lot of concepts, where you're going to be generating ideas. And I do as well mentoring sessions. So this is 101 through Zoom or Skype. So this is 12 sessions over 3 to 5 months. And some of you who are following today and later have done it. I think it works very well and I enjoy doing it as well. So this is it for today. If you have any questions, let me know. I hope you enjoyed it. Again, expiry tomorrow, we get this pin. So there is a big call spread on the S&P, I think at 4,700, but there is a lot of gamma exposure at 4,700, 4,750. Market is driven by very few names. Oh, I got a question from Rika. Gregoire, when you have a long short, how do you ensure this do go your opposite way? I understand you read financial info. However, the market can gap at that. So to avoid the gaps, Rika, that is a question that appears very quickly when you trade stocks. So when you're trading FX, so people will be starting trading with FX. So there is no gap unless you carry a position over the weekend, but even the gaps are going to be very small. So what happens with stocks is, yes, and you've probably experienced that during the earnings season, they can open down or up by 20% or plus, especially in the US. So what we do when we do a long short, when we get exposure to equities, is we first we try to understand by how much the underlying, and any underlying could be moving. Okay, so you'll be looking at the historical volatility. You'll be looking at the ATR, which is the average true range. on a weekly, on a monthly, on a quarterly, and you try to say, okay, by how much my asset could be moving. When you trade equities, you say your worst case scenario is actually never your worst case scenario. There is even worse than that. So if you get an ATR of 15%, you can make sure that instead of the asset moving by 15%, the asset is going to be moving on the open by 25%. Okay, and that was true for this education check, okay, which went down like crazy. So first thing, you try to get by how much the asset can be moving, and as well, you can be looking at any earning season that you had before by how much the asset has been moving on that day of the earnings. Okay, so this is historical. As I told you, recap before, during this earnings season, when the implied volatility for a stock, let's say, was at 25%, the realized volatility was much higher most of the time. So the stocks have been moving up and down much more than what they were expected. So one of the ways to mitigate those things, first is you can do a pair trade. So when you do a pair trade, you want to believe that those two are going to be mitigating each other. So meaning that if JP Morgan is down 10% on the day, there is a good chance that Bank of America could be down 5-6% on the day, because, you know, this is a read through of the sector. But if it's not, and if you get everything wrong, what you could do as well to avoid those gaps, especially as you know that there is earnings coming, is to use options. Okay, when we use options, either if you want to be long the stock, you long the stock and you buy out of the money put. So I give you an example. The stock is trading at 100, you long the stock at 100, but you say, Rika, I don't want to wake up one morning and the stock, when on the earnings, opening at 80. So what you're going to say is, my worst case scenario, I'm okay to be losing 10, but no more than that. So you'll be looking at still being long the stock and buying an out of the money put at 90. So obviously there is a cost attached to that, which is coming up very often with earnings, but you're going to be losing 100, the stock to go from 100 to 90. And then from 90, your put will be kicking. Okay, so you'll be losing the 10 plus the cost of the premium. So depending on the strategy, depending on the upside downside, meaning your risk reward, we could be doing options. What I don't want to do is, like some other educators and many retail traders, what they are doing these days is everything options, because in the long run it doesn't work. I can tell you that it really doesn't work. I've experienced that as an educator and professionally, it just doesn't work. I know it sells well as an educator, but please don't only do options. So Rika, I hope it helps. I hope I answered your question. If you want to know more, just send me an email and I'll try to come back quickly at you. Okay. Thank you. For those in the US, have a good Thanksgiving. So talk to you in a couple of weeks. Enjoy the family. Enjoy the nice food. And for those of you in Europe, enjoy the very quiet market because the US will be closed. All the best. Bye-bye, everyone.